So today we will talk about credit spread options. We'll talk about some basic and uh, the reason why we traded this and how we can trade it. For those of us who are been trading the credit spread, maybe a good time to review it. And for those who are new, we'll do very basic steps here so that we can understand it. Okay, so as always, just quickly to mention on the disclosure here that we are not licensed to do any security advice. So this is just for informational and educational purpose only. Make sure that we consult with our own um, professional before making a trade. All right. So today the subject would be the credit spread. And these are the four things that we're going to be covered today. First is what are credit spreads? And the second one is we're looking at the two scenarios, bullish and bearish spreads, and how we can maximize the credit spread, which is how we can set up the trade and to maximize the premium we can collect it as much as possible. And then there's a couple of the basics rules and could spread more rules, and but I just list some very fundamental rules so that we can keep in mind and remember it. As I mentioned earlier, if you have any questions, feel free to interrupt and ask away so that we don't forget about it, right? So let's start with what are the credit spread. This credit spread is also we call a vertical spread, and credit is the vertical credit spread, or the other way is the vertical debit spread. So the vertical debit spread is you pay more than you sell, but a vertical credit spread is you're collecting more premium on the sale compared to the one that you buy. So what is a credit spread? It is an option. It's just an option strategy that involves a purchase of one option and a sell of another option in the same class, the same stock, at the same expiration date on a two different strike price. Right. So let's say we buy 150 calls and then we sells 152 calls. So it's the credit spread. So the strike price is the difference. The rest is the same expiration, same stock. So that's the credit spread. So the intention is to collect the premiums more than what we pay for on the other strike price. Okay. So yeah, it is designed to make a profit when the spread between the two options narrows and expire worthless. So the idea is that we want our collect the premiums and let that option go to expire out of the money or worthless or narrow it down. Let's say we collect a dollar. We want that spread to narrow, come back to 50 cents, 30 cents, 35 cents, or zero would be the max gain. All right. So that is the credit spread. So we'll give an example next year. And so the question is, when should we trade the credit spread? A couple things here. First is the technicals. If we have a stock that trading in the trading range, and all the support and resistance overbought, oversold. So right at the stock, when you see it maybe pull back out the support and then about to continue about to bounce back, or it got up to the resistance and about to turn around and come back down. All we do in the trading range, let's say between $100 to 120. So in the trading range, right next to the support, right next to resistance, and we can do a bull put or a bear call. Another factor would be a small directional move and for the optimum on the spread, we want to select the one that have a higher volatility, but a higher IV, so give you more premium, and with the high IV, it can the premium can really go down really fast. But we don't need a big directional move. We just need to have a small directional move. Okay, so that is the idea behind it. Okay, let's give you an example here. Okay, maybe I'll talk about this. Okay, for example, okay, so let's say we the stocks is okay, so let's see the stock going like this, and let's say we have this is $100, okay, and it's $120, okay. So the idea about why we take a credit spread is uh, is a preferred method of a strategy to trade, because there's four scenario, right? The first scenario is that the stock is going up, right? Second is going sideways, right? And third is slightly uh, up or slightly down. And up or down in a bigger way. Okay, so we got four scenario, right? So in order for us to make profit on a single, let's say you want to buy a single car, you have to have one direction. This have to go up for you to make money. Okay, it have to go up. So it have to go up for you to make money. It's this scenario. Let's erase this. So up, sideways, slightly up or slightly down. Missing the letter N here. Okay, all down. Okay. So in order for us to make money on this on just a car, this up here have to go really fast and enough to get the option to go into the money for us to make money. Okay, to be profitable, it's have only one. Do you want go one direction and go good in the direction enough so that you in the money for us to make profit on doing single call. Same thing if for this we bet the stock gonna go down. We buy puts and the stock have to go in one direction, right, to go down and have to go down good enough, get in the money for us to make money. For example, this morning we have A, B, and B, right? We buy single on that. It have to go to the 190 calls and have to be above 190 for us to make money. It was up this morning when the market opened compared to yesterday close, but still the option was 50% less than what we paid yesterday. So that's showing you that buying single is have to go up and have to go into the money on the call side, and the put side same thing, have to go down and go into the money for us to make money. However, with a credit spread, okay, with the credit spread, if we buy we do a bull puts, right? A bull puts. If we do a bull puts or a bear calls, there's 3 scenarios that we can bank on the money, okay, or this one, okay. So let's say we do a bull put, okay. We only need the stock to go up a little bit, slightly up, or even sideways, or even go down a little bit, as long it doesn't go below our sale price. Let's say we sell at $100. Okay. If the stock can go down anything, and let's say the current stock is at 105, okay, let's say it's 105. So all we need to do, all we need on the credit spread to make money on credit spread is that it either go up a little bit, okay, or go sideways, or even it go down a little bit, as long it's above our sale price, okay. And we almost guarantee be profitable on that, okay. The only time when we lose money is at the directional going. Let's say we do a bull put here, but the stock go in just one direction, okay, going down, okay, then we lose money, okay. So we win on 3 scenario and risk 1 scenario, all right. So the chance for us to make money is more than buying single. That's the idea behind this strategy, okay. The stock only don't have to go up at all. You can move just sideways, just a slightly up, then we be profitable on that trade, okay. That's the idea behind the strategy. Versus buying single, then you have to bet that the direction have to go in one direction, the direction that you buy, and either puts a call for you to make money and have to get into the money for you to be profitable on it. Unless we do a day trade, that's a different, when you're talking about the whole idea and general ideas, okay. So that's the idea of the strategy, that we don't need the stock to go in our direction at all to make money. Okay, it can be either up if we do call, sideways, slightly up, or even slightly down, then we make money. The only time we lose money is to go against us in the really fast way. Just like NVDA yesterday, we do a credit, we do the bear calls, and it went up. So it went against us and went fast. That's when we lose money. Okay. Anybody have any questions on it? Do you understand it? So that's why people who buy single, they say about 90% of the people who buy option lose money because of that. Okay, because you get, and then plus you got IV, okay, implied volatility, and then you get decay. Okay, so decay means the time value, the extrinsic value, as it approaching the expiration, the decay get higher. Okay, all right. And you probably heard about gamma squeeze. Okay, I just want to touch a little bit on this. Okay, and gamma squeeze. Gamma is the volatility measure of the volatility of the delta that when it gets close to the expiration, the gamma can increase versus the time decay. So the gamma and time decay, the decay have to be more than the gamma for you to make money. If they do shenanigan, they try to manipulate this stock, they can increase the gamma by squeezing the gamma squeeze. And that way your decay is not fast enough, and the gamma squeeze can really affect, especially those when we get close to the expiration date. Okay, like in the same day credit spread. That's why we do that on Friday. Make sure we lack in profit when we have it, or if I'm really convict, do a conviction trade on Friday, then I just don't worry about the gammy because yeah, when they and they squeeze it, um, then you have to take a loss on it. But that's the risk about taking the same day credit spread, is that you might have a gammy squeeze. Okay, so that the idea behind why we take this credit spread. Everybody understand that? Okay, so we go to the next phase here. So an example of credit spread. Let's say that we started with an example of a credit put spread. Okay. I don't have to do that. Let's see. I thought you can check that out. Okay. So with the credit put spread, so this is an example of the credit put spread. Okay. Let's say we see that this Apple, for example, is Apple is going up or starting to bounce at the support level, and we are bullish on Apple. Let's say Apple, we are bullish on Apple. Okay, so we see maybe doing this, and now we are bullish on Apple. Okay, for example, okay, this is Apple stock. Okay, so for example, this, and then we take a credit put spread. So we would buy 110 puts and sells 112 50 puts. So we sell and we collect the premium at $2, and we buy it and we pay at $1. So the difference on that is $1 between the two. Okay, so we collecting $1 because we collect $2 when we sell 112 strike price, 112.50, and we collect and we pay $1 for 110 strike price. So we collect the difference is $1. Okay, so the net profit will be $1. Okay, let's say we do 10 contracts that represent a control of 1,000 shares of Apple. Then we collect a premium of $1,000. Okay. For example, looking at this side right here, so when we do this setup, put spread, we collect $2, we pay $1, we keep $1 here. And so the strike price when we sell it is right here at 112.50, okay? And then we bought 110. So the break even, this is the break even price. How do you calculate the break even price? The break even price is the spread, which is the distance between the buys and the sell, okay, which is $2.50. Okay, the distance here between the sell and the buy is $2.50. We minus what we collected, minus the premium that you collected, and it's equal to $1.50. Okay. Okay. So you take our risk is $1.50. We collect $1. Our risk is $1.50. Right. And so we take the sale price. We minus for this $1.50. That is take a sale price minus the premium that we collected. This is our break even here, the 101.50. Okay. So all we need to do, all we need is that Apple stay above this price, $111.50 above this price, then we make profit. and we start losing money as it go below our break-even price. Okay, and with the max loss of $1.50. Okay, a max loss of $1.50. So when we into the trade, we already know what our max profit would be, our max loss would be. Right, so with the trade setup, already know how much we potentially lose and how much we will make potentially make on the trade. So we got a max loss and max gain already in place that we know exactly. Okay, I have a little Excel sheet that for our members, I can post it in the room for those. You can use the Excel and then you can enter the stock and the price, and then it calculate your premium that you want to collect it. Okay, well, I'll do that later after this. I'll show you how that works. Okay, so this is an example of a credit put spread. We predicting the stock gonna go up. We are bullish on the stock, so we do a credit put spread. All right, and so the idea is that this strategy is that, again, mentioned in this earlier, that we don't need Apple to go to whatever, $150 or something. We don't need Apple to go that far. We just need Apple to either move up a little bit, okay, or moving sideways, or even down a little bit, as long as stay above this price right here, okay, then we will make money, okay. So that's the idea behind it. If it go up this way, nice, okay, it's okay. The only time we lose money is it turn around, it pick a direction, and it move fast, it going down that way. Then that's when we losing money, when we go into this area right here, okay. So anything be here, that will go on, and anything up here, then we'll make money. So we don't need the Apple to move quick on this direction on the upside at all. Just moving sideways, slightly up, or even slightly down, as long as above our sell price on it, then we will make money on it. And our sell price minus the premium that we collected. Okay, now we're still profitable, right? So that is the credit put spread. Let's go to the next one. So these are some of the example here. You can read that. I will post it in there. You can, which I just explained it to you how this works. Okay. Same thing with the credit cost spread. Okay. So for example, Apple again. Let's say the credit cost spread. Let's say Apple going like this, right? And it hit this resistance and it's time to kind of go this way. Okay. So we have maybe double, triple top here. We may start cracking below the support level right here. So we are bearish on Apple. If we bearish on Apple, if we expect that it hits the resistance coming back down or crack the support to come down, then we do a credit cost spread. It's a little bit of confusion because basically credit is stand for short. Okay, so so you short a call, which means you bearish. Okay, and you do credit put, you short the put, so it means you're bullish. Okay, but you short the call means you bearish. So credit call means bearish because you shorted, right? So just credit means shorted. Okay, just think of it that way. The reason we do this because we do spreads, because let's say you can short a call. Okay, you can short, they call it naked short. If you do the naked short, all right, okay, if you do the naked short, you put yourself in a really higher risk, and you have to have a couple $100,000 in the account or so to short one contract, because it's you margin and it use and then the stock can go up as forever, right? So they have, the broker require you to have enough money if you're gonna get you're gonna get the you're gonna get the direction wrong and it go against you. So the naked short is that you only short, let's say you short 115 call, okay? So you just short it, you don't do the spread. Okay, that you call a naked short. So it requires high account equity in account and require high margin for you to short just the naked short, and it's very risky if it go against you very fast. Okay, so that's why we do the spread. Okay, so we do the spread so that we don't have get into the scenario. You can do the spread with a $2,000 account. Okay, you can do the spread with the $2,000 account as a margin account, and you don't have to worry about the stock gonna go against you and you have unlimited loss because you already capture your loss here. Okay, capture your loss here. So to get back into here, so credit call, which means we bearish on the stock. So we do the opposite. We're gonna buy for example, 117.50 calls, and we're gonna sell 115 calls. So we're gonna collect a $1.50, and we pay 70 cents. Okay, so our premium is 80 cents that we collected. Okay, we collect 80 cents with, let's say, for example, 10 contracts, you collect $800 at a premium. If again, if Apple just moves sideways, or a little slightly up or slightly down, then we got to keep the premium. But if it go against us, go up like this in one direction fast, then that's when we lose money. But anything here, it's moving sideways, sideways, or slightly up or slightly down, okay, then we'll make money, be profitable on that trade, okay. So that's the idea behind the strategies again. So we got three directions that in our favor, plus the IV and the decay. There's some additional factors as well play into that, right? So that way we can have a better chance of being profitable trading option versus buy a single call or a single put. That's why I like to do singles on the intraday only, so I can get in and out pretty quickly if it go against me, unless there's some setup for that on the single that can give us enough time to make money. But in the high volatile market like this, doing singles a little riskier. Better to do the credit spread on them. Okay, so that is the idea. Okay, what's the next one here, Samson? This is what I just explained to you. We'll post it there, you can read it. Okay, this is the next step here, how to maximize the credit spread. Okay, I put this in the Excel spreadsheet so you can calculate it yourself. Okay, for example here, we want to be at about 40% on the profit, and we risk 60%. Okay, the lower on the profit side, you have to increase your winning rate. So for example, let's say we buy 150 puts and we sell 152.50 puts, and we collect $1 here. We are at 40% because the difference between 150 to 152.50, and that is the $2.50. But we collect $1, so we only risk $1.50. So you only need to win 60% of the time to break even. If we win 70%, 80% of the time, which is we do it very oftenly here, then you end up at weekly or monthly, you're profitable on a trade. The idea is to be profitable, not to win every trade. Okay, that's the difference. We cannot win every trade. If anyone to tell you that they win every single trade, I would get your 450 horse Camaro and run away from that person. Okay, so the idea is to be profitable over time. Okay, weekly, monthly, whatever that is. Okay, so we do 40% so that we collect the premium 40% of the total spread. Then you need to be winning at 60% to be profitable. But if let's say we collect the premium only 30%, then we have to win 70% of the time to be profitable. Okay, sometimes we take these trades because if I see a directional move, then I would take these trades a little bit more risk, but you know, we can bet on it, a little speculative. But to be on the safe side, has the proven record. We want to stay on this side right here, at least 40% to collect the premium of 40% of the spread, so that you can stay profitable over the long term. Okay, month in, month out, weekly, week in, week out. But if the less premium that we collect, it can put us on. You have to be at a higher rate winning ratio to break even or make profit on it. We do this, you know, in the day trade. We do on a Friday, maybe we can take that risk because we only do in and out. But you know, weekly or monthly, we want to be on this side as much as possible. Unless we see a directional move that we can speculate on it, then we can maybe do this. But I want to stay on this side right here. Okay, to be profitable, you want to be at a 40% or higher. So that way you don't need the big winning rate ratio to make money on it. Okay. So these are the basic rules here. All right. So when we get into the trade, I would always, most of the time, that I would scale out or take profit when I have 50% out of the max gain or higher. I would scale out. Okay. But let's say you don't have time, you know, you're a busy professional. I would recommend doing this to create a bracket order. Some of the broker, TD Ameritrade, allow you to do bracket orders. Some of the platform allow you to do this as well, so that you can set up a trade. You know, you can scale out 50% gain, then stop loss 60% of the max win, and you stop out. So those are the rules. It's not exactly the time, but if you follow these rules, then you get a higher chance to be profitable at the end of the month. Okay. So these are the basic rules. Make sure that we follow it as much as we can. If you cannot do it manually, try to do the bracket order. So set up in advance with the bracket order. That means, you know, one they call it OCO order. So if one thing trigger and cancel the other. Okay, see cancel. So one order trigger and cancel the other order. Okay. So this order trigger and the other order get canceled. So let's say you set up that and got your 50%, you scale out, then it will cancel the stop loss. But if hit the stop loss 60%, it will cancel this. Okay. So so some basic rule there, so we can be profitable in the long run. Okay. The longer run here, I'm not talking about years like Warren Buffett. I'm talking about weekly, monthly, okay, in our strategy. Okay, I'm not talking about 5 years like Cathie Wood or Warren Buffett for 30 years. Okay, we're not doing that. So those are some of the basic rules that you might have it down. Yeah, I'm going to show you this. So we got. Okay, so this is the Excel sheet that I created. Okay, let's say we're here the stock, so you put in the ticker stock, the sell strike price, and the buy strike price. Okay, I have a scenario right here. So if you want to be profitable at 40%, 40% or 30%, and it will tell you what premium here that you would collect. Here, the premium that you can collect, and the risk that you will take on it. Okay, so that is something that I put together. You can always, you know, do it yourself. Let's say we have today UPST, for example. So let's say, you know, what was UPST earlier? Say, you know, earlier 140, 145. So 140. So we do 140. We do a puts, right? So we we would buy closer to the price and sell far away from the price. So let's say we do 145 and 140, 135. So we would sell 140 and we would buy 135. Okay. I need to change this thing. So basically, this is the $5 here. So minus the 2, so this is the $3. So instead of 350, so this is there you go. So we would collect $2 and we risk $3, right? So that's then if we collect $1.50, then we risk $3.50. Okay. So that you can I'll post it in the member room so you can have it. Okay. You can change, you can put in the tickers and you can put in the price that you sell, you can put in the price that you collected, it will calculate it, the minimum that you want to collect, which minimum price you want to collect depending on your risk profile. Okay, so we'll have that posted for you as well. Anybody have any questions? Is that helpful? I know that it might be confused a little bit, but I want to encourage you to listen to the webinar again if you need to review it. Okay. So this spreadsheet is created so you can keep track. We have to manage our money, or our money will go away. Okay, so you have to manage it in what trade did you, how much risk you enter the trade, and how much money you want to collect at the beginning. So again, quickly to review this quickly here. So we talk about a credit spread. So we buy and sell at the same time, simultaneously. At the same time, we sell and we buy. The sell strike, the sell premium is more than the purchase that we pay, the purchase premium that we pay for, so that we can collect the premium. The idea is to capture the move, the three scenario out of the four. The moving sideways slightly against you or slightly in your favor, then you'll be profitable. Okay, and that way you can get your option premium, option spread get narrower and or expire worthless. Then that will keep the max gain when it's go worthless. And so we're looking at to set up a trade by looking at the technical side and some other factors as well, which I do that for our room. Study this as much as we can. Sometimes we get the stock go against us. That's the nature of the business. But we do this homework as much as we can so that we can set up the trade in our favor. And the credit put spread is when we bullish on the trade, bullish on the stock. Again, when we bullish in the stock, doesn't mean the stock have to go up. It should need to go up slightly, go sideways, or even go against us slightly, small against us. Then we still profitable. Same thing on the other side. We are bearish on the stock. We want to do a credit cost with, so that we can capture the move and sideways, or a little bit down, or a little bit up. The only thing that go against us is when it go up a lot. And then it go against us, and then we will be lost on the trade. But we capture on three directional move, three scenario of the move out of the four. Okay, plus the implied volatility and the decay kick into that. So we got a lot of things working in our favor doing the credit spread. Okay, and this is the scenario of maximize your credit spread by staying how much risk do we want to take. So we can focus on the lower risk or higher risk, depends on the stock that speculative or more of a directional move that we see it. So depends on the risk, your risk profile, your taste of risk. Then you can you decide which one you want to take on it. Right? And some basic rule here we want to keep in mind that scale out and take profit when you have 50% of your max gain. Stop loss when you go 65% of your max gain. The credit, and also if you're possible and you're a broker, then you can create the bracket orders so that you don't have to worry about that. For when it go, you can set it up and then go play golf. Okay, and we have this Excel sheet here that you can enter the trade. Before we enter the trade, you can just make a little visual math here so that you can see how much you collect, how much risk you take, and all these, so you can enter that numbers. Okay, we'll post it on our member site. Thanks, everyone.
Don't forget to like and subscribe to our channel. Reach new levels of trading proficiency. Become a member at turbotrading.biz.